I figured I will help explain the difference between a traditional and a Roth account with simple numbers, things that we can easily understand since we're already real estate investors. And the end goal is to use our retirement for investments that we know, which is real estate. All right, so for this first example, we're going to look at a flip. All right, so we'll say our initial contribution will be at your current tax bracket, which is probably 32% if you're a single captain. And over here, we'll look at traditional versus a Roth. Okay, so for both of these examples, we'll say that you use the CARES Act and you've got $100,000 in both self-directed accounts. Now, you bought a property for $100,000 and within a few years, you sold it for $150,000. As you know, you're just looking at the past 5 years, the appreciation rate, that is an easy number to get. So we'll say that we'll sold it for $150,000. So our profit is $50,000. All right. Those numbers are easy. All right, now let's say that you're going to retire. As you mentioned, you want to be at a lower tax bracket, is 24%. And roughly that's between, I believe, $84,000 and $162,000, which is modest. And especially by the time you retire with inflation, that's really modest. But we'll use this for an example. All right, so our total is going to be $150,000 for both, right? Well, first we'll look at the traditional. As you know, with the traditional, nothing is taxed, but it's tax deferred, which means when you pull it out during retirement, that amount is taxed. So 150 minus, now you're going to be at the 24% tax bracket of 150, and that's $36,000. That gives you a total of $114,000. Now, this is just looking at federal taxes, but as I confirmed with my accountant, if you live in a state that also has state income taxes, you're also going to get knocked, but depending on your state. So this is going to be less than $114,000. Now the Roth, as you know, the profits over here are never taxed. What is taxed is the initial contribution of $100,000 at your 32% tax bracket rate. Well, that's easy. So 32% of $100,000 is $32,000, giving you a total of $118,000. Now I also confirmed with my accountant that this is immune to state income tax. So as you can see over here, it's easy to see that the Roth produces more with this flipping example. Now let's look at another example. I mentioned on the chat yesterday about if you have a self-directed IRA, you can lend that retirement money to a deal that Rich has. Maybe he has something very lucrative, you'd like to get in on it. And of course, he would appreciate the initial funds. So now let's look at this lending example with Rich. Okay, again, your initial contribution is at your current 32% tax bracket, and that'll be $100,000. And the Roth, also $100,000. Now, as I mentioned, you're going to be lending to Rich, and we'll say at 7% for 10 years. Well, how much is that going to be? Well, if we do an interest-only loan, which is very possible and very easy with real estate, I could show you that later. Using the rule of 70 divided by 7 is 10 years. By the rule of 70 says in 10 years, we can double our initial investment. And you could check this with your financial calculator too. All right, so that means in 10 years, you just made $100,000. Again, you're going to be retiring at 24%. As you mentioned, you will probably be in a lower tax bracket yourself. So those numbers are easy, right? $200,000 both sides. All right, now let's apply the tax. First on the traditional end. Now, traditional, you're going to be taxed $200,000 at 24%. So 24% of 200, that's easy. That's $48,000. Let's do our math. $152,000. Again, less because depending on your state. If you have state income tax, that's getting knocked down even more. For example, in my state of Colorado, that's another 5.5%. Now, the Roth. Now, the Roth, you mentioned that it's the initial money is taxed at the initial tax bracket. The profits are never taxed with the Roth. So it's simply 32% of 100,000, right? Which is equal to, that's easy, $32,000, giving us a total of $168,000. Again, the Roth wins, and it's immune to state income tax.
Wow, I wish HR would have explained it to me that simply 20 years ago. With numbers, it's easy to see. Now, if you're ready to grow your retirement plan with real estate, just like this example, let's get you on my schedule at layovermoney.com/chatwithmike. and let's get you started with the self-directed IRA plan that works perfect for you. And good news, next week I'll be grading and ranking 4 of the best self-directed retirement custodians so you don't have to. So subscribe to my channel and have a great holiday.